Hi, I'm Max Keiser. This is the Keiser Report. If you'd like a copy of Storm Still Blowing, it's now available at maxkeiser.com records and tapes for $9.99 for a Christmas special. Hopefully we bleeped out all the offensive bits. Hey, let's get to the news. Stacy Herbert, you're looking fetching. Tell me something good or bad.
Max, it's only bad news these days, you know that? I'm going to start with this headline. Hind Capital's Ben Davies. Global debt has peaked and there is no exit. So the title of his report, Ben Hind, and of course you can see in this photo here that it's a still from which show?
Our show! We make the news, and then we report the news that we made.
But here's the title of his report, Debt, There Is No Jubilee. And of course he's talking about the fact that, like in biblical times, when debt became too big, there used to be a debt jubilee. All debts would be written off. So now we're not allowed the debt jubilees. No. We're enforced into slavery. So he's saying, how do you get rid of debt without jubilee? You can only do it through four things. Grow your way out, belt tightening, currency devaluation, or 4, explicit default. However, if you look at the headlines that you and I have been talking about, Max, there is no exit, obviously, for the 99.99% of the world's population that are peasants. However, if you recall our last headline in our last episode, Warren Buffett has an exit. He's got Uncle Sam.
Hello, NetJets. Warren Buffett's company. I need an exit. I need a vector. I need a vector now. Help me.
Well, look at this exit plan for the corrupt global money printers, the debt pushers. Here's a tweet from James G. Rickards. As we predicted, IMF has devalued the dollar inside the SDR basket. So dollar now losing to gold and SDRs too. Of course, nobody else, you and I, Joe Bag of Donuts, Pierre Bag of Baguettes, has no option to trade in the SDR.
Right.
You have to pay all your debts in the dollar. These people get to pay and devalue dollars via the SDR.
Right. And Rickards is really a guy you got to watch. He's an insider on all things financial. And he's absolutely right. The SDR currency, a fabricated new global currency, is the shadow banking system attempting to give lots of folks an exit strategy to swap their dollars for something else on their way to buying precious metals and other assets that are moving up in price. For these folks, they see nothing but inflation. For people who are trying to work for a living, they see stagflation. They see prices for food and energy going up, but their wages are going down. For economists like Ben Bernanke, he's a paid deflationist. All he sees is deflation, which means that all he's ever going to do is increase the money supply, and that money supply only ever goes to the rich. It never goes down into the real economy, and this is obvious because we never see wages going up. You see, that's the point. Anybody who's watching this, like frickin' Obama, just read the frickin' newspaper.
So here, they're the top of the pyramid, this global money class. Now, next line down, you have the national politician who defraud and bankrupt their own nations for these people. Let's look at the exit for the politically corrupt class. Recession proof. Congress got richer during worst downturn since Great Depression. 261 members of Congress are millionaires, nearly 1 in 2 lawmakers.
Pigs.
Well, partly the reason for this, of course, it is the exception to the rule for Congress is insider trading. They're allowed to trade on insider information. And what has been going on? But Congress has been providing stimulus packages, bailouts, TARP programs. So these guys have been able to front run every single bailout they're about to provide.
Yeah, let's repeat that. Congress, by law, is free to trade on inside information. That's a law. They're free to trade on inside information. Oh, gee, I wonder how they get to make so much money. I guess because they're really good politicians. Yeah, that must be it.
There's also an exit for the corrupt global speculator class, the kind of leech on the side of this global debt printers and central bankers class, and that is shorting Obama. Exclusive, George Soros tells top progressive donors to give elsewhere if this president can't do what we need.
Yeah, shorting Obama.
So he has that exit. He's allowed to just exit the bet that he's made.
Yeah.
We're stuck with whatever policies.
He didn't do his due diligence. He put money into Obama without really looking at under the hood to see what this guy was all about. He financed campaigns to get him elected. Now he realizes he made a mistake, and he's out the door. And he's leaving the public with this schmata guy, behind the lectern, mimicking whatever Jamie Dimon tells him. And he's not there. He's a robot. He's a robototron. He's some kind of dictaphone. He's a eugenically created, genetically You know what Soros was buying last quarter, of course, was Monsanto. Talk about genetically modified hell. Okay, this guy Soros is a plague on society.
Soros also leads into the next headline, which is exit for global monarchs. Because if you look at George Soros's portfolio, 30% of it is in oil. Headline reads, OPEC is set to pocket an extra $177 billion by year's end. So OPEC's export earnings from crude oil are already up by $161 billion year over year, according to the U.S. Energy Information Administration.
Yeah, and Soros, he has those insider trading charges as well that he's dealing with, and he'll buy his way into expunging his record and make it all go away as if it never happened, even though, take the Bank of England, he busted the Bank of England for a quick $1 billion. Pure market manipulation. He wrote a book called The Alchemy of Finance. He could have retitled the book, How to Manipulate a Market. He's a master market manipulator. He's a fraudulent, no-good-nick who has no skill, but he has a lot of chutzpah. That's about it.
But, tying into the other stories that we're talking about here, Max, OPEC is headed by Saudi Arabia. They are the biggest member of OPEC. Now, Dick Cheney and George Bush set up this situation for them where they're, not only do they have Dick Cheney's zombies across America who basically will shout and scream if you dare try to get them off the umbilical cord of Saudi Arabian kings giving them oil.
Yeah, one thing Bush said that was kind of interesting. He said America's addicted to oil, as I recall. Yeah, give me some more barrels, buddy.
Give us some more.
Give me another hit. Whatever.
So, and of course, the reason why the dollar is devaluing so fast and therefore oil prices are rising is, of course, from the money printing going on by the global banking class, as we said in the beginning of the show. Headline reads, Gap, Walmart clothing costs rise on terrifying cotton prices.
Uh-oh, is that my cue?
Oh, go ahead.
Jump down, turn around, pick a bale of cotton. Jump down, turn around, pick a bale of two. You see, I predict within a few years the biggest employer in America will be cotton pickers. And of course, they'll shop at the company store, Walmart. And amazing thing is, if you hadn't shopped at Walmart for the past 20 years, you wouldn't be out there picking cotton. Sucker!
So cotton futures in China have surged by more than 70% this year.
High, going higher, baby. Cotton is something you just can't live without. Who wants to go out the front door without a clean pair of underwear?
You can read in the quotes in this article the very definition of hyperinflation in this quote from a Chinese supplier of cotton. We can give clients a price now, but it will only be valid for a week. That goes back to the beginning of our show where we talked about Ben Davies, Hind Capital. He's saying that there's hyperinflation, warning of this happening in Japan, US, and the rest of the world.
Right, and that time frame will continue to shrink. So we'll give you a price, but it's only good for 3 days. We'll give you a price, it's only good for 3 hours. We'll give you a price, it's only good for 3 minutes, because that's what hyperinflation is all about. That's how you get to 3, 4, 5 trillion US dollars worthless, nothing paper, contango idiocy printed on the backside of a baseball card and fed through a shredder and re-amalgamated with a chicken McNugget and served up on a plate called hyperinflation, and now you, sir, are bankrupt.
Well, and then here's another sign of hyperinflation, which is giving no exit for the people down below. As we said, we had all those exits for all of the big money class. Fears of new food crisis as prices soar. So the UN said that the bill for global food imports will top $1 trillion this year for the second time ever, putting the world dangerously close to a new food crisis.
Cannibalism. I'm going long cannibalism.
Well, the thing is that China is now introducing price controls on certain foods. So, of course, this again brings us back to
Nixon.
The Great Depression. Well, during the global Great Depression, you had same sort of currency wars going on, devaluations, devaluations against gold, as you're seeing in the SDR. You're seeing price fixing, and tariffs will be, I guess, the next step.
Right, and let's be clear about something. First of all, America is not the currency manipulator, or I should say, China is not the currency manipulator that America would like the world to believe. America is the currency manipulator. It's got the world reserve currency. And why is there such a problem in America and the global economy? It's because Americans basically have become too lazy. They don't want to work anymore. They just want to borrow money and consume from China, and China recycles that money back to America to keep interest rates low, and therefore they never have to actually get a job, and they go down to Walmart and prices have gone down for 35 years, and they never actually have to work. But now the whole thing is reversing, and the people are like, oh my God, I don't get it. Prices are going up. I thought my birthright was to shop forever at Walmart and never have to pay. And to get out of that conundrum, they're falling back to Jesus. And they're saying, I'm a religious fundamentalist. I've got a birthright to shop for cheap stuff at Walmart. Don't you get it? Jesus gave me that right. And the rest of the world is saying, oh my God, I thought you were a separation of church and state. Oh my shemegegegi, sell my dollars, they've gone crazy. Sell my dollars, buy shekels. Americans have gone crazy.
Well, and that brings me to this final little bit here, because we've been running this viral campaign, Crash JP Morgan, Buy Silver. And I noted a comment on one of these viral videos, which is from Chetty Rod, and he says, Max, what is Sir Tony going to do if JP Morgan goes bust?
Sir Tony?
Tony Blair. He's not a sir, of course, but he really is. He's part of the oligarchy, aristocrat sort of class, dominating the world with their fraudulent schemes of Ponzi schemes and defrauding us.
He's a surreptitiously stealing money from people kind of a sir.
Well, of course, because he consults for JP Morgan at $2 million a year, and that goes back to the exit plan for the politically corrupt class.
Right.
As we talked about, they're allowed to insider trade, and in the UK, they're allowed to walk out of Downing Street, walk across the street, and walk into JP Morgan, say, give me $2 million a year.
And in Tony Blair's case, he converted to Catholicism as well. He's got the double play. He's got the JP Morgan bonus and the Jesus play. Good work, Tony. You're a war criminal, and you should be hanging from a rope somewhere. All right, Stacy Herbert, thanks so much for being on the Keiser Report.
Thank you, Max.
Don't go away. Much more coming your way, so stay right there. Yeah, hi, and welcome back to the Keiser Report. We talk about on this show many times inflation, hyperinflation. We don't talk about deflation so much. So I'm very pleased to bring on the show Nicole Foss, who, amongst other things, I would say, is a prominent deflationist. Is that a fair characterization?
Very much so, yes.
Now, Nicole, your work, you come into this economic field coming through geology, coming through oil, and being a systems analyst. And this is very important because your work really focuses on credit and credit systems. Give us a little, 10,000-yard look down at the credit soup.
Well, essentially, what we've had is an enormous Ponzi scheme develop, an enormous quantity of Ponzi finance. This is what happens when you have an enormous credit expansion. You build excess claims to underlying real wealth. So this is one kind of inflation, because inflation is an increase in the supply of money and credit relative to available goods and services. So you can produce inflation through increasing the money or increasing the credit. But there are significant distinctions between those two. If you increase the money supply, the money fraction of that, then you may be Weimar Germany or Zimbabwe, but you could increase the credit side instead. So if you have gone the money route, what you have is your underlying wealth pie that you then cut into smaller and smaller and smaller pieces. If you have a credit expansion, you don't cut the pieces into smaller pieces. You create multiple and mutually exclusive claims to the same pieces of pie.
Very similar. You probably looked at the work of Steve Keen.
Yes.
Okay. Now, he makes the point that it's in a fractional reserve banking system that we have come to know. Somebody puts money into the bank, then the bank lends out maybe 10 times that deposit as loans, and then you have a multiplicity. Mm-hmm. According to what Steve Keen says, and I gather what you're also saying, is to point out, no, you have to realize that the whole system begins not with a deposit, but it begins with a loan, essentially. We're talking about a system that's built on debt from the beginning, that there really is no reserve at all.
And the reserve requirements have been whittled away.
Right.
The number of accounts, the kind of accounts you have to hold any reserves on at all, have been whittled away. The then reserve requirement on the accounts you still need a reserve on are much less than they used to be. Each one of these increases the multiplier effect. So you have the multiplier effect of fractional reserve banking. You also have enormous amounts of credit creation in the shadow banking system. Everything has acted to increase credit.
And the multiplier effect here is a multiplying of claims
Yes.
against the same asset.
Exactly.
Now, it's similar, for example, if I were to sell the same house to 10, 20, or 30 different people. They each claim to have
Yes.
an ownership of that house.
Yes.
However, that can't possibly be the case.
Yes, and what you have is then excess claims to underlying real wealth. So we're all playing a giant game of musical chairs, only there's perhaps one chair for every 100 people. And you can imagine what happens when the music stops. That's deflation. Everyone grabs for a chair.
Right. So ultimately, when you end up with, as I guess who said that all debts that can't be paid won't be paid, I believe it was Dr. Michael Hudson who makes that point often. So now we're at a point, I guess in 2007, where you hit what's called peak credit. Their Ponzi scheme is finished. There's no more dumb money to come in. The last trailer park has been turned into an asset to be monetized and securitized and sold on Wall Street. Now you've got the credit crunch. And this is happening in parallel with another phenomenon, which is the oil crunch. So part of the deflation story is also, your view is oil going forward is on the slippery slope down.
Yes. I mean, essentially what happened in 2007, you had the stock market peak. Money that was leaving the stock market flooded into the commodity market, gave us the 2008 oil price peak. And I was trying to explain when I was working in energy at the time, that the next step for oil prices was going to be off a cliff, because whenever you get speculative flows of money flooding into a sector, which creates a Ponzi scheme, a smaller scale Ponzi scheme, you are going to have that money come in, take profits, and leave again, and then a speculation goes into reverse. The prices fall very sharply, which is exactly what happened in 2008. If you look at the oil price pattern like this, that's exactly the same as the tulip bulb mania in Holland, or the South Sea bubble. It's a classic bubble pattern, is this, only that was on a smaller scale than the entirety of the bubble, the entire credit bubble that we're looking at. So money was going out of stocks into commodities. I think we're going to see possibly the same dynamic again, but I think we are going to see oil prices fall again. Money is once again moving into the oil sector on speculation. And this is just the theory that there will always be a greater fool. It doesn't matter how much you pay for something, someone else will always pay more later. And I think we are seeing speculation in oil at the moment, not to the same extent as in 2008. But I think what we're going to see in the oil sector is speculation goes into reverse, prices fall, and then as we move further into the credit crunch, then demand starts to fall as well, because a depression involves a fall in aggregate demand, and that will undercut price support. So then you end up with a temporary oversupply, and that really pushes prices very, very far down, perhaps to lowest cost producer.
Talk a little bit about the hard ceiling and the supply glut. In other words, as the economy shrinks, the demand falls, there is the infrastructure to generate supply. It's quickly gobbled up, but because of the low prices, there's not the incentive to bring more production on stream. So you've got this ratcheting down effect and the hard ceiling. So unlike a speculative chart of these wild swings up and down, here you've got this hard ceiling due to lack of production, due to the lack of infrastructure investment that is permanent, the systemic permanence to this because of the cost associated. And talk about that hard ceiling some more.
Well, essentially what you have with the credit bubble, first it will buy you time because you get this temporary overproduction until you crash supply. And you crash supply, as you were saying, because if prices are low, nobody invests in exploration or drilling or production. You get the capital coming out of the sector. You set up an almighty supply crunch down the line, because not only have you not brought on anything new, in a credit crunch, you don't even maintain what you already have. And a lot of the oil production infrastructure is already not in a particularly good state of repair. There's an enormous amount of investment that would have to go into this infrastructure just to continue to allow it to do what it does now. So when we start to find that the infrastructure is decaying, we haven't brought in any more production, At that point, you have a supply crunch. If the economy is trying to recover again, as you were saying, it hits a hard energy ceiling at a much lower level than before. And because energy is the physical capacity to do work, if you do not have enough of an energy supply, you're not going to be engaging in economic activity in anything like the way that we currently do.
Okay, let me take the bull case for a second, because prices are set at the margin in the paper market, in the futures market, and these markets are driven by folks with enormous pools of capital, and they're able to overwhelm the normal supply and demand curve, and they can take a price, as we saw back a couple of years ago, to 147 or so. And most of that move was driven by speculators with huge funds able to overwhelm the normal supply and demand and create a price, fabricate a price, manipulate a price. So as this money that's being created right now to try to combat the economic slowdown, it's bypassing the real economy, we know that. And it is going into the pockets of these fund managers. They're being rearmed, if you will, with more and more cash. And they like oil as a play. They like other assets as a play, as a way to game that system. So is it, I think, as I understand the bullish case, is that as these central banks continue to flood the market with more credit, more cash, but basically, as we know, it's credit, it's more debt, this will be the favorite place for that, is in these markets. So where does that argument fail?
Well, I do think that you are going to see that kind of driver effect, but speculative bubbles do not go on forever. You can't simply blow an infinite bubble. So what the speculators do, they do flood the market with hot money, essentially, but they will make their money, and then they will take that out. They will chase momentum to the point where they don't think there are any more profits to be made, and then they will leave that sector for the designated empty bag holders of that particular situation, and then you'll find that prices will fall.
Let's talk about this infrastructure. We hear U.S. politicians say the U.S. needs to focus on energy and replacement for oil. Are the plans credible? What's happening?
They're not remotely credible, not even vaguely credible. I mean, what they're talking about is energy independence through biofuels primarily, although various other forms of renewable energy as well. But the emphasis in the plans that you hear most about are on things like ethanol and from things like switchgrass. It's absolutely not going to work. The energy returned on energy invested for these is incredibly low.
Right, so the amount of energy it takes to get the energy out is greater than...
Exactly. Not for every one of them. They do vary from one technique to the next. Biodiesel is slightly better than ethanol, and it depends what you're getting the ethanol from as to what the net energy out is. Ethanol from corn is energy negative. The net energy is below 1. Return on energy invested is less than 1.
Right, and the only reason we have that is because of the enormous subsidies that the corn industry receives, the agricultural industry from the U.S.
So it's a money-generating system, not an energy-generating system.
Right.
And various other ones. If you were doing ethanol from sugarcane in Brazil, you have a decent net energy return on that. It's about 8 to 1. It makes no sense for corn ethanol. Quite frankly, it makes no sense for cellulosic ethanol either. It's never going to scale up. What you could do with this material is you could put it in, say, an anaerobic digester and turn it into biogas if you don't mind having a gaseous fuel instead of a liquid one. You would certainly get a higher energy return on energy invested if you did that. You wouldn't come close to replacing the energy we get from oil, though. Really, absolutely not even close. Even if you used every inch of the land surface purely for growing crops for that purpose. So
yeah, even if you are generating energy in this way, you still have to move it to central distribution areas, which would once again rely on the infrastructure, which is in decay.
Exactly. And to some extent, you may have to expand infrastructure. There are two ways you can use...
But there's no money.
There's not going to be any money. That's exactly the thing.
Right.
So, and there are two ways you can do it. You can either use the liquid fuels as liquid fuels, or you could generate electricity with them, which is one of the ways that people deal with this. But again, you get an infrastructure issue because then you have a problem with power grids. An awful lot of the power grid infrastructure is at or near the end of its design life as well.
All right.
And
let me change gears here for a second, because I think we get the picture. You've got infrastructure collapse. You've got oil supply collapse, and you've got credit collapse. You've just come back from Detroit.
Yes.
Now, Detroit is a post-modernist American city, post-industrial American city, and you see the true green shoots, I would say, of some hope. Tell us about Detroit. We have about a minute and a half to go.
It's an absolutely fascinating place. These people have completely given up expecting anyone to do anything for them. They are just decided we have to do this ourselves, and they are. I mean, where I was staying, there were vacant lots. There were houses falling down. There were houses in a state of incredible disrepair. And in between the houses that were falling down, there were permaculture gardens. And they are growing potatoes in stacks of old tires. They are setting up herb gardens with the bricks from the houses that are falling down as the structure. And they're doing this with no money whatsoever. And nobody comes in and trashes these gardens. I mean, in theory, you hear that places like this are no-go areas. They're absolutely not. Where I was in Detroit, I'd walk down that street at night. People would politely come and ask if they could pick a tomato from the garden. And these were truly lovely people who'd completely taken their future into their own hands to the extent that they could. They don't have much purchasing power, so they don't have as much freedom as other people would. But I think the fact that they have stopped looking for anyone else to help them and are doing a tremendous amount for themselves is a hugely positive aspect of what's going on there.
All right, Nicole Foss, thanks so much for being on the Keiser Report.
You're very welcome.
And that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacy Herbert. And I want to thank my guest, Nicole Foss. If you want to send me an email, please do so at keiserreport@rttv.ru. Until next time, this is Max Keiser saying bye, y'all.